Okay, cool. So I expect we'll have a few more people joining, but I'll just get started. So thanks for joining. Uh, this will be about a 1 hour stream, I think, 30 minutes or so of presentation, and then I will open it up to Q&A. My first time doing a live stream, so forgive me if this is not the most polished thing ever. Before I get started, one important disclaimer first. This presentation is only for educational purposes. This is not investment advice. All opinions are my own, and I make no representation about their accuracy, completeness, nor relevance. This is not endorsed by eToro nor affiliated with them. This is my private presentation with my market outlook. Of course, trading may result in the loss of your capital. You should consult a certified financial advisor to discuss your own personal financial circumstances and the suitability of any investment product, including eToro, and of course, including copying my portfolio. And of course, past performance may not be indicative of future results. So in terms of the presentation, I'll be covering two things. First, I'll be talking a little bit about the portfolio itself, the investment strategy that has led me to this particular set of stocks. I will give a bit of a performance update about the portfolio and share some thoughts about the market outlook, in particular for the next 12 to 18 months. As you guys may know, that one of the most important positions within the portfolio is the exposure to Asia and China in particular. So I'll spend a little bit of time talking about this and why I think it's a pretty unique asymmetric opportunity. And then I will be going through this at a reasonably fast clip so that we can spend as much time as possible on Q&A, where you can ask me anything about the companies in the portfolio, the strategy, basics of investing. You can ask about myself. It's an AMA, whatever you feel like. So let me start by just introducing myself briefly. So my name is Theo Sanders. I'm Dutch, but I've spent most of my adult life living outside of Holland, including the last 13 years here in Singapore. I spent another 4 years living in Thailand before that. Most of my career has been in the technology and entertainment industry. I started in entertainment in 2004 with, if any of you guys are video game players, you might know Blizzard Entertainment. I was working on World of Warcraft. I helped them create BlizzCon, their big convention. I moved from there to Razer, the mouse keyboard laptop company, where I was in charge of their global product design and product strategy, basically. Then spent 5 years at Ubisoft, which is a French publicly listed video game developer and publisher. Then the 5 years up and before 2 years ago, I was a CEO of a company called Helix Leisure, which is a mid-sized tech company that serves the out-of-home entertainment industry. So things like theme parks and cruise ships and video game arcades. Excuse me. And for the last 2 years, I had a big entrepreneurial itch. So I have created my own company called Sybil Entertainment, which is a consulting company for both the technology industry and for entertainment companies. So I tend to work with CEOs on solving some of their strategic challenges. I've been investing for a very long time. I did my first public investment, as in buying, publicly traded equities back in 2003. So I think I should be coming up in the next few months on my 18th year anniversary of investing. I also do other kinds of investments outside of eToro. I'm a pretty active angel investor. I've started a number of companies, one of which is actually launching next week. It's an e-commerce startup. So it's really a passion of mine, and I'm really happy that with the copy portfolio system in eToro, I'm able to share that passion with people and hopefully help them out a little bit. I've actually only been on the eToro platform since March 2020, so I was a pretty late adopter to copy trading, but I really think it's the future. Okay, moving ahead. I won't spend much time on this, but in terms of my goals for the portfolio, my objective always, and this is true before eToro as well, is on any 5-year rolling basis to outperform the S&P 500 by an annualized 5 percentage points. And so if that means if one year I'm 6% ahead of it and the other year I'm 4% ahead of it, I consider that successful. And of course, carry that on for any 5-year cycle. Furthermore, I'm very conscious about risk and risk-adjusted performance in particular. So I think it's one thing to have massive percentage gains, and another thing to achieve those in the context of not taking crazy risks. So eToro, of course, provides a risk score, which is pretty good, but not perfect. But if you were to go and manually calculate my Sharpe rating over the past year in eToro, you'd see that my, my performance relative to the risk I've taken has been pretty good. And the last thing, since there's a number of people, some of whom are on the chat now, who I know in real life, who I know don't want to think about their portfolio too much, I wanted to create something that was very dollar cost averaging friendly. So what that means is, of course, it's not just about opening a one-time position, but every month, 2 months, 3 months, every 6 months, whatever you feel like, creating a portfolio that has enough stability, excuse me, to dollar cost average into, so that over a long time the volatility is removed and your investment returns are smooth. Because depending on when you start your copy, between one day and the next might be a few percentage difference depending on what the market's done. So this is of course not true for portfolios that are very volatile by nature. Okay, moving on. Now, I did a little bit of a survey which many of you filled out, which I really appreciate, about the things that you wanted to hear during this call. And one of the things that came up most often was a little bit of insight into portfolio strategy and investment basics. So there's many ways to do this. And I will walk you through the way that I've been doing for about 18 years now. I've been pretty consistent. So I'm what you might think of as a macro investor. I start my investment strategy at the very top with things like geopolitics, socioeconomics. I'm not an economist, but I have a pretty strong background in economics. And from there, I develop a whole bunch of ideas that I think will be true of the world in the future, over the next 5 years, 10 years, things like that. Now, not all of those ideas are good investments necessarily. And to give an example of that, obviously we're going to go through a massive transition from petrol-based automobiles to electric cars in the coming years. But in that particular instance, I feel most of that transition has already been priced into the market and then some. So really what I'm looking for are ideas that have enough unique insight and identify some opportunity. There's still gains to be made from investing against those concepts. So I typically prune down that list from about 20 to 30 concepts that I have. And I tend to focus on 4 to 5 at a time. Right now with eToro, I'm focusing on 4 of them. I may add a 5th at some point in the future. And with those ideas, I look for things, I make sure they're uncorrelated to each other. So there's no point in, for example, believing that air travel will rebound after COVID, and there's no point in believing that sea shipping will become more and more efficient as hydrogen power sets in. When there's so many things that those two industries have in common, and so many of the same catalysts, including interest rates, that would make them both go up or both go down kind of at the same time. So I'm looking for generally picking a couple of uncorrelated investment themes. So from there, the next question becomes, how do you invest against the idea? And of course, you can buy stocks and companies who are in the industry. You can buy an ETF or an index or other financial instruments that represent that investment. So this is a stage where I start doing some pretty deep diving financial analysis. I read company public filings, I read industry reports, all sorts of pretty tedious things. And I'm trying to understand which investment instruments make the most sense to invest against the hypothesis that I'm setting out to do. And I go through the list for all of the different themes that I'm doing and come to the final step, which is quite boring and technical, but is extremely important to actually achieving the portfolio goals, which is kind of the weighting and risking. So to give you 2 counter examples of that, first, the idea that the rise of China represents a unique investment opportunity in our lifetime. That's an idea that I have very high conviction about, and that I believe the markets have not priced in whatsoever at the moment. Whereas, for example, the idea that the luxury goods industry will go on a very strong run in the next 5 years. I do believe that to be strongly true, but there is already a premium on luxury goods companies, a valuation premium. So I have less conviction in that idea than I do the China idea, and thus I give it a lower weighting in the portfolio. So there's a very deliberate balance between the four ideas and also the hedges that accompany that, what I pick. So I'll actually walk you through an example. So the example I'll use is the idea that I call more money than sense. It's about the luxury industry, especially the ultra premium luxury industry. So there's a couple of things on the macro side that led me to this belief. First is that within the developing world, and in particular in Asia, we are not just seeing an unprecedented number of people move into the middle class, the upper middle class, and the very wealthy class from an absolute perspective, but even from a percentage perspective. Asians in general are becoming very rich very fast. And living here in Asia, you just need to walk around the Louis Vuitton boutique here in Singapore to see massive queues forming outside. And that's true across China. It's been true across Japan for a number of years. So I think that Asia will create and will drive a really lucrative time for luxury goods. It's also a very recession-proof industry, with the exception of COVID to some extent when all the duty-free shops in the airports closed. Luxury goods have generally been very resilient to any kind of economic downturn. So if you look back to 2008, 2009, when we had the great financial crisis, all the companies like Louis Vuitton just continued performing, delivering huge profits. And that's a nice macro theme to have in the portfolio. And finally, my belief is that, in a world where everything is becoming more automated, where artificial intelligence is destroying value in some industries and creating a whole slew of new disruptive companies, that luxury goods is actually almost anti-technology. And that the very best companies in luxury goods are the ones that can communicate that craftsmanship of people working in ateliers in Milan or Paris or London or New York. And the whole shopping experience is not a technology-driven experience. It is a very personal one. So it's kind of strange that the richer people become, the more they crave this personal interaction. So having kind of established that as a investment theme, the specific things which have led me, my three criteria for choosing the investments were first, obviously fashion especially is very cyclical. Trends come and go out of fashion very quickly. Second, I love the business model in fashion of extremely high margins that are protected by exclusivity and protected by marketing. However, there are many companies in the fashion industry which don't enjoy a very good business model, even though they might be in a really good place. And finally, I look for companies, and this is true for any theme, that are pure plays. So I wouldn't invest in a company that is, say, 30% exposed to luxury and 70% other stuff, because even if I'm right about luxury, then the performance of that company might still not reflect that being true. Again, this is a smaller part of the portfolio, and there are a few unique risks associated with it. I think the biggest of them to me is the consumer preference of China, which for most of the very high-end luxury companies represents about 40% of revenue, 40 to 50% in some cases. So if you look at other extremely exclusive segments of the luxury industry, for example, fine wines, antiques, art, fine art. 10 years ago, the Chinese were going to auctions in London and buying all the Renaissance masterpieces. Today, they have primarily lost interest in that, and they are actually buying Chinese art and antiques and sending those prices through the roof. Now, as of today, there's been no real shift in terms of leather goods, automobiles for the most part, fashion as well. They still are aspiring to primarily Western brands, the Louis Vuittons and the Chanels and things like that. So these are the criteria I set to evaluate this portfolio. And I'm going to simplify this a lot because I probably spent about 3 to 500 hours in total researching the luxury goods industry over the past 2 years. So I'll speak about a couple of the companies that I looked at and tell you just why I did not pick them. I'll tell you why I picked the ones that I did pick, and one that I really like actually, but I don't think is a very good fit into our portfolio. So Richemont is and I think there's actually at least one French person in this chat, so forgive me if I butchered the pronunciation. That's a conglomerate of luxury watches. This immediately fails the business model test. Probably the hottest segment of the luxury industry is in fact watches, but it's all happening in the aftermarket. And the luxury boutiques don't have the option of just increasing supply to capitalize on that boom, because as soon as they do, they lose their exclusivity. So I would invest in a secondhand high-end watch dealer today much more quickly than I would invest in the actual manufacturer. So Richemont owns like Audemars Piguet and Breitling, I think, and many others. So I'll skip Kering for a second. Ferrari is interesting. So obviously it's a highly desirable brand. People all over the world love it. It represents everything that's beautiful and good about fast cars. But there starts to be bleed into other themes like the move from petrol engines to EVs. And so even if it doesn't even matter to me if Ferrari is successful ultimately in that transition or not, it's probably going to be more influence in terms of its share price by its ability to execute on that EV transition than it would be by its ability to create amazing brand recognition. So it's not a pure play. So the same for VF Corp, which is probably the least well-known of these companies here. This is a conglomerate of brands which recently acquired, I think last year they acquired Supreme. If any of you guys are into streetwear or any of those like hypebeast kind of trends, you'll know that Supreme is the absolute king of these brands. Like every marketing student in the world should study what Supreme has done. They have innovated. They probably are the most innovative marketing company of the last decade. However, again, we run into the problem that there's 80% of the portfolio that is not luxury oriented. So as much as I like Supreme and as much as I think VF is actually a good investment, it's not a pure play on this thing. So that left me with a choice between LVMH and Kering. So Kering owns Gucci, I believe, and a bunch of other companies. LVMH is a conglomerate of about 30 fashion brands spanning leather goods, clothing, watches, fine wines, and other things. I think that LVMH is much more future-proof than Kering, even though Kering has some brands that are currently very hot. And that is primarily because LVMH has proven, it's like the Disney of fashion. You guys might have seen that post I made. It has proven its ability to be resilient to consumer change and taste. So it either starts acquiring other companies, and it is able to do so in a way that adds a tremendous amount of intrinsic value to those businesses. So it acquired Coco Chanel, or Chanel, I think four years ago or so. And by my estimation, the goodwill on the balance sheet of LVMH for Coco Chanel is probably ×4 what they bought it at. So they are phenomenal integrators and acquirers of other companies. And they've also just proven, to be good at the kung fu of dealing with fickle consumers. So if you go to an LV boutique today, you'll see $5,000 Louis Vuitton Nike sneakers. They are catching on to the whole streetwear trend as well. And then finally, Farfetch, which is kind of like an Etsy or a Amazon for luxury goods. I think it's a really interesting company, but it just flies in the face of my hypothesis that what the consumers of luxury goods ultimately want is that human touch. And to me, there's limits on how far you can get with e-commerce in this space. So I hope that kind of gives you a picture. I mean, I just picked luxury as an example of my thought process going from hypothesis to selecting investments and evaluating them against different criteria. And then finally, in a bit more mathematical way, if you will, arriving at risks, weights based on confidence, their correlation, understanding the different risk factors, and so forth. So from there, and this is accurate as of today, I manage myself, as I trade over the weeks and months, I dollar cost average up some positions, I dollar cost average down. About once a week, I update this report for myself. I have published it a few times before, where I have set a target exposure range. So for example, with the rise of China, I want to be between 20 and 25% exposed to that hypothesis. And as you can see, as of today, I'm only 16% exposed to it. So it's not like an emergency kind of situation. I'm 4% beneath my minimum what I want to be, but in general, I will be averaging, or I will be taking more positions in China and for less positions, for example, in the fortress stocks, which are the part of the portfolio that I believe will actually underperform the S&P 500, but they provide all the stability to the more aggressive plays like luxury, China, technology, and entertainment. I can come back to this if people have questions about it, but this is roughly how I manage the relative balance. So how I ensure that my hypotheses are actually manifested in investments in the percentages that I'm looking for. So moving on from there, a quick review of the portfolio performance to date. So I started in eToro in March 18th, 2020. So right as the markets were crashing. So I had a couple of rough days right as I joined, actually. I caught the tail end of that crash. Since then, based on the eToro kind of common metric of a 10K copy trade, the portfolio has performed at 95%. The S&P 500 over that exact same period has performed at 46%. So obviously the performance goal has been met, at least for this year. But I think what I'm more happy with is that on a risk-adjusted basis, I've not been taking a whole lot of crazy gambles. And the eToro risk score stands at 4. The Sharpe ratio stands at something like 1.4 or 5. I think last I calculated it manually, which is good. And most importantly, the drawdowns have been reasonable. So the 5 days, sorry, the -5, -7, and -10 you see here are the most amount of money I've ever lost in a 24-hour period, a week period, or any length of time, be it 1 week, 2 weeks, or 6 months in the course of a year. And that's a very important characteristic to having a lower risk portfolio. Excuse me. It's not all been good. I had probably the worst trading month in more than 10 years in January. Many of you know that because the majority of you guys were already copying at that point. When I say the worst trading months, I don't mean in the sense of I lost the most money. I've had way worse months where I've lost 5% in the past or 8% in a month. I probably lost 15% in 1 month back in 2008. But January was a month where there was risks that hit the portfolio that I did not foresee. In particular, in the waning days of the Trump administration, he specifically attacked 4 companies in one day. Xiaomi, Alibaba, etc., all of which were in the portfolio that all dumped 20%. Then the week after that, President Xi in China kind of had a confrontation with Chinese big tech, in particular Jack Ma of Alibaba. And it just went on and on like this throughout the month. There's always something happening that I didn't really foresee happening. And unfortunately, by the end of it, I lost a little bit, not fully, but a little bit my discipline. I started over diversifying and not trusting myself, which is why I consider it the worst month. I wasn't following my own advice, and that was a real lesson learned. And for anyone who took a brief dump, I mean, we're back in February, obviously, but for anyone who suffered through that, sorry, that was a significant learning experience for me and a reminder of things that I should know after 18 years. Okay, so enough about the portfolio. I'll share a few thoughts about the market. I think the most pressing question that anyone looking at the US stock market would have today is, are we in a bubble? You have probably seen news reports of the Warren Buffett indicator, which is basically the value of the Wilshire 5000 versus the GDP growth, has now exceeded the level just preceding the 2008-2009 crash. There is an increasing amount of doom and gloom being peddled in the market. Yet at the same time, we just came through a very healthy earnings period. Companies are actually making a lot of money right now. Tech companies reported phenomenal earnings, and more traditional industries reported bad earnings, but not as bad as the market kind of expected they would. So that creates a very contradictory situation. From a valuation perspective, everything suggests, run for the hills, put your portfolio in cash, hedge like crazy. But from the perspective of is the economy actually recovering and how are companies profiting, it's been actually very, very good. So I think we're in a very unique market situation. And I think our ability to look back at the past for clues about what will happen in the next 6 months, say, is very limited at this time. Of course, there's other X factors that complicate that even more. For example, interest rates now for 20 years almost have remained, or at least 12 years, have remained close to zero globally, negative in some Western economies even. Now, you would expect from classic economic theory that means there's going to be massive inflation in the future, but just 2 days ago, we had the US January inflation numbers, the December inflation numbers, and they came in at 1.2%, which is honestly nothing. So what I can kind of conclude from this is I don't know if a bubble will burst. You generally don't know if you're in one until afterwards. The position that I'm personally taking is there probably will be a very sharp correction, but I'm not convinced it will happen that soon. So I'm positioning a little bit cautiously in the market right now. You'll see in my portfolio I have a couple of hedges in there, like an inflation hedge for Exo, which is an iron ore miner, a market valuation hedge, which is the VXX. But for the most part, I'm just going to ride the bull market. And like when you get on an airplane, you have you do the little emergency briefing. I have an emergency plan if it comes to it, but I don't. I'm not convinced it is worthwhile to right now go into emergency mode and try and sit out this market. I think we are in unique trading positions that have never been seen before, and no one knows what's going to happen, good or bad. Okay, next thing, when do I think the world will recover from COVID and how will it recover? My frank assessment is we won't be back into any kind of a normal until 2022. You just need to look at the data of vaccines coming into the market now to reach that same conclusion. I think tech companies have, by and large, adapted themselves. I don't think there is much post-COVID upside for most tech companies anymore. I think it's all been achieved already during the pandemic. I think for a few very specific industries like travel, outdoor leisure, hospitality, things like that, there will in fact be a V-shaped recovery. I'm quite confident about that looking at the data from the Chinese economy. However, I think that much of that's actually already been priced into the market. So I'm not convinced that a cruise ship company, for example, will suddenly shoot up in earnings as soon as there's good news about vaccinations. I think there's a couple of key themes worth looking at for the year. So myself, I'm working from home 3-4 days a week now. Or now it's actually 2 or 3 days a week. But the nature of offices will change even when people are allowed to go back to work. There's great consumer expectations and employee expectations about being able to work from home, having more flexibility built in. And I think many of those things will continue to exist past COVID. I believe the companies that enable that new hybrid ecosystem or hybrid work office ecosystem will be pretty well positioned in the next 5 years. I think another key theme that's going to impact the world, but maybe not our portfolio so much, is the whole move towards renewable energy and green energy. So in particular, green energy in Europe and renewable energy primarily in the United States. So the US seems to be a little bit, even the Biden administration, a little bit less focused on how good the renewable energy actually is for the planet, whereas the Europeans are all about it. So I think that'll actually kind of go in two directions. Now, unfortunately, I think that there is very little alpha to be made at this point in time with the current valuations in renewables. It may still well go up for a few more months, but so much of this has already been priced into the market. Now, two more, I think, it's not a big surprise. Again, renewable will become a big thing, but Two things which are maybe more unique insights, which I think will have a massive impact on how we should all be investing in the coming years. First is the time to market for deep tech. So there used to be this kind of very well understood progression from theoretical science into research laboratories, universities, peer-reviewed papers, to kind of early adopter tech. And maybe after 10 years after we first heard about the science, we might have our first commercial application. And that application might mature 10 years after that into a big business. And that's certainly been true of things like the internet, where we were, I think, in the late 1970s when that started becoming sort of hypothesized and tested a little bit. And it took a good 15, 20 years after that before it became a thing. Now, I believe that cycle from crazy hypothesis to a massive industry is 5 years now, with all the intermediary steps. So if you look at really cutting edge science today, be it genome engineering like CRISPR and stuff like that, or some of the more advanced applications of artificial intelligence or spaceships or all these kind of things, like we don't have to take 10-year horizons anymore to look at an idea and come to the conclusion that this will change the world. Like we can start investing earlier and more aggressively. And I think the other thing that's sort of come with this, and I'll skip this a little bit because I'll talk about it more in the next slide. But the idea that the business life cycle is much faster than it used to be. So the whole process from a company being a startup to starting to mature into its profits to being stable to eventually declining, that used to be a 30, 40, 50-year process, and that's now 10 years. So you've got this massive compression, which I think actually supports the valuations in the market we're seeing for some tech companies, including ones that we have in our own portfolio. Now, I think the other big theme for at least the remainder of this year will be a bunch of unknowns in the new Joe Biden administration in the United States. We've already seen a very quick kind of disintegration of the whole unity message. We're going to work across the aisle. That was one of his electoral campaign promises. I don't care about politics. I mean, I do, but not for the purposes of this call. But it does mean a few things for us as investors. First of all, it means that the stimulus is all but guaranteed because he's already said to the Republican Party, we're going to push this through budget reconciliation. There's no time to wait. I don't want to negotiate with you. So the $1.9 trillion stimulus is more or less guaranteed at this point. He has articulated his tax policy. So that's mainly going to impact larger companies in the future that are very profitable. It probably will have the greatest impact actually on companies that have been very effective in using the tax loopholes that exist. So companies like Apple, for example, that park all the profits for Europe and Ireland. This part he will have to negotiate with Congress, so with the Republican minority. But I think he will push some sort of compromise version of this through. I think the most extreme version of it, probably not. And I do think this is really going to weigh on earnings and also on valuations, probably towards the end of the year. I don't think he will enact this. I think it's going to be a 2022 concern for all of us. Two big unknowns. One is his position against big tech. So obviously that's been all over the news and the headlines, Apple, Facebook, and kind of their deteriorating relationship with society. We really don't know how Joe Biden is going to play this from a regulatory or legislative perspective. And also his position on China. He's kind of said, everything that Trump did, I'm going to put on hold, and I'm going to be doing a review over the next 3 months before I really articulate my China policy. Now, we know that he's not particularly friendly to China. I mean, it's one of the few things that Republicans and Democrats have in common in the United States. They both see China in this kind of fixed pie game with winners and losers, and basically as a strategic competitor rather than as a partner. So what he will do with China, I don't know. What I do know is that he has not rescinded the Trump executive orders or the ones made by Wilbur Ross, Trump's Secretary of Commerce, to delist companies like, to blacklist companies like Xiaomi, which have ties with the Chinese military. So that's also the reason I'm currently not invested anymore in that stock, but I will be monitoring what happens in Washington closely. Okay, only one more part to the presentation before I get to the Q&A. I want to share what I think is the most important idea in our portfolio, which is the Asia thesis. And this is one that speaks to me very personally because I was living in the United States in California until 2006. And as a European, growing up in Western Europe, we always saw the United States, at least when I was a kid, as this kind of aspirational place where if you wanted to make it in life, you wanted to live the American dream, you would go to America. That was what we all believed in. We were influenced by Hollywood, and of course in 1989, the fall of the Berlin Wall. And it took me a couple of years of living in the US that I realized, shit, I've actually bet on the wrong horse here. I'm probably not positioning myself in the best possible way in my own life by being in the United States right now. And that's really what motivated me to move back to Asia in 2007. We've gone through an American century from the end of World War II to, I'm not sure I would say today anymore, to maybe minus 10 years ago from now. And I think it's fairly inevitable that the next 100 years will be more defined as an Asian century than an American one. And at the very heart of that Asian century, while there's massive opportunities here in Southeast Asia, where I live in Singapore, in emerging markets, frontier markets like Myanmar, Laos, Cambodia, India represents a massive opportunity of its own. But by and large, this will be, at least the next 30, 40 years, a century defined by China. So here's two people that hopefully you'll recognize if you've read a bit about investing. That's, of course, Bogle and Buffett. Most of everything that we know about investing today comes from one of these two guys. Between the two of them, I think they kind of represent 75% of common knowledge. So in Bogle's case, the whole idea was invest in low-cost passive index funds like the S&P 500. That should be 60, 70% of your portfolio, depending on your age, and just forget about the market. And Warren Buffett's idea was always, forget about the market at all times. Just invest in big American companies that are going to be around for 20 or 30 years. The right time to buy is now. The right time to sell is never. All these different witticisms and thoughts that we've heard. Now, I think there's something in... Sorry, I got distracted by a pop-up here. I think there's something that is true for both of these guys. And don't get me wrong, I have massive respect for both of them. But they are really both products of that time, kind of starting at the end of the Great Depression and really accelerating after the Second World War and really coming into full fruition in the 1950s and 60s, of a situation where you could bet on America and you would never be wrong. America was at the start at that point of at least a 60-year ascendancy that arguably continues until today. So does it still make sense in 2021 to blindly bet on America? I think that's very arguable, but I think it's a less clear-cut case than it was during the time of Bogle and Buffett. So you've probably seen tons and tons of statistics about China. Most notably, it became the #1 source for foreign direct investment in the world this year, just last month actually. It is expected to be the world's biggest economy on a nominal basis by 2027 or 2028. I tend to gravitate towards 2028 actually. It's winning the trade wars initiated by Donald Trump in a big way. I won't go into the mechanics of it unless you guys want to hear about that in the Q&A, but I'll just say they are. They have, like we used to think of China as a giant factory producing iPhones and rubber toys and all sorts of little knickknacks that would then get shipped to the Western world and consumed by its consumers. That is a very antiquated way of thinking about the Chinese economy today. They are have very quickly modernized. It's a modern service economy. They are innovating. In some areas, they are out innovating the rest of the world, in particular in areas like AI, 5G technology. They're just about to overtake the Japanese in the area of robotics. A lot of the technologies that will probably define the next 10, 20 years. From a geopolitical perspective, China has a strategy, and it's called the Belt and Road Strategy, basically. But they have basically linked uh, access to raw materials, access to cheap labor as China moves up the economic value chain, with their own economy and a tremendous amount of liquidity and a tremendous amount of public borrowing into a cohesive 25-year strategy that we're now about 5 years into, spanning roughly from Central and South Asia all the way down here to Southeast Asia and Singapore. Um, they have also taken the reign of America from the perspective of who is going to lead the rest of Asia through this Asian century. I would have said 5, 10 years ago that could have been the United States, but during the 2016, so the Obama election, the Trump when Trump was first elected, both political parties basically turned their back on the TPP, which was the Trans-Pacific Trade Agreement, which would have positioned America in the center of everything. They said, we don't want to be part of that. We will focus on our own stuff. So inevitably, China saw that as an opportunity. They forged a new agreement called the RCEP, which was agreed in December of last year and should be ratified by all the member countries by the end of this year, I believe, maybe early 2022 at the latest, worst case. And that is a free trade agreement covering about 30% of the world's GDP and about 15 major economies. India is, however, not part of it. And I think the last thing, China, if we were to rewind, let's say, to 1989, when obviously we had the Tiananmen Square, there was a real risk whether the Chinese Communist Party ruling in the way that it does, obviously in a very non-democratic, very autocratic and authoritative way, at least from an economic perspective, could create sustained prosperity, or if they would fall victim to, social rebellion, to pushback, to things like that. But with some obviously very notable exceptions in places like Shanjing province and in Taiwan, within mainland, like within coastal mainland China, there is a massive sense of nationalism, a massive sense of pride, and a massive collective feeling of ascendancy that I find is very common to many of the Chinese people I interact with myself, which is quite a lot of them. That's perhaps a little bit how America felt in the 1950s or 60s. If I look at the US today, I think some of that social cohesion, which you need to make long-term strategic decisions, which might hurt you today to help you tomorrow, is probably today at an all-time, well, not an all-time low. I mean, the Civil War obviously was much worse, but is at a very low point in its history. So I could go on for literally 3 hours about different attributes of the Chinese economy, but imagine a bunch of numbers that are all going up, up, and more up. Now, why do I think there is in our lifetime, unprecedented opportunity to invest in China today? So I'm showing you here 3 companies, Shopify, Amazon, and General Electric, that are at 3 very different stages of their life cycle. So obviously Shopify is growing extremely fast. It may well double its revenue every year for the next 5 years. Amazon is growing fast, but it is definitely maturing. It is now optimizing profits. It is generating tremendous amounts of wealth. And General Electric, which is a company that was founded in, I believe, the late 19th century, is in a state of terminal decline. It can still be a very profitable, you can actually invest very successfully in declining companies, but it's a different kind of investment than investing in a Shopify or an Amazon. So as you guys know, in general, the more potential a company has in the future, the earlier in its life cycle it is, the greater of a valuation premium we expect to pay for it. We are happy to pay a trailing PE ratio of 500 on Shopify because we know it's going to double next year. And at today's price, that will become a 260 PE ratio. And at today's price, 2 years from now, that will become a 130 PE ratio, and so forth. So as long as Shopify keeps growing, it can justify an extreme valuation like 500. Amazon is not going to double year over year. They're still growing very fast. While again, GE, you pay the cheapest price for every dollar of earnings because it's in a terminal long-term state of decline and relevance. So that's just like, that's complete common sense. That's how equity should be priced. You take more risk with companies like Shopify than you do with Amazon. But the returns are dramatically greater in terms of how fast a company can grow. So if you were to translate this to a macroeconomic perspective, we're actually seeing this today, which I find very strange. So the weighted average PE ratio of the S&P 500 today is 40, which is very high at the moment. But even if it mean reverts down to say 25 or 30, these are the trailing PE ratios for the Hang Seng, which is the Hong Kong index, and the Shanghai Shenzhen Stock Exchange, trading respectively at 15 and 14 P ratio. So this doesn't make sense to me. There should be a little bit of a premium for being an American index because there's more liquidity in the United States for now. There is somewhat better corporate governance in the United States. But fundamentally, you have two economies that are on very different trajectories. And I would argue that China's trajectory today is the Amazon, and that the United States' trajectory is, maybe it's a bit harsh to say it's a General Electric, but let's say maybe it's a Coca-Cola. It's growing at 2% per year, probably for the next 30 years. So if you kind of agree with that conclusion, I'm really simplifying this a lot now, that growth should be rewarded through valuations minus a risk adjustment. These two things are just completely backwards. It should be the Asian indices trading at 30 or 40 multiple, probably 30, not 40. And it really should be indexes like the S&P 500 that are trading at 15 or 20, because that future growth is not there anymore. And when you see something this obviously inverse, you create an asymmetric, you have an asymmetric situation where the upside of being right is tremendous. The downside of being wrong is relatively small. Now, don't get me wrong, these are both very volatile indexes, both the Hang Seng as well as the Shanghai Shenzhen Composite. They are very volatile industries, but on a 5-year basis, there isn't much further down to go. I mean, probably 10, I guess, would be kind of a floor towards aggregated earnings. So you kind of have to be of the position that somehow all these Chinese companies and the Chinese economy are going to stop growing in order for these valuations to make any sense. And there is no credible evidence today. There are some risks, of course, that's going to happen in the next 5 years. So I am extremely bullish about Chinese equities, and I think most of all, I am viewing it like being an American investor in 1950. You are about to be investing in a situation where you're investing at the start, maybe 10 years into the Asian century, where as long as you move carefully, you will make a tremendous return. And I think that's my last slide, actually. Okay, that is. So thank you guys very much. I really appreciate everyone sitting through that. I hope it didn't take too long. You can feel free to ask me any questions you want about anything in the chat. And just keep in mind, I have about a 10 or 15-second delay from you guys, so it might be a little bit back and forth. But you can ask me about any of the companies we're holding, markets, geopolitics, macroeconomics, investing basics, my favorite food, whatever you want. All right, who wants to be brave and ask a question in the chat here? Uh, okay, so if there's probably what I'll do is this. There's no immediate questions about the presentation, so sorry, I do have a quick question here. You stated early on that you plan to increase your percentage in big tech to meet your portfolio weighting goal. Is it not overvalued and at the risk of regulation, both of which you alluded to or mentioned in your presentation? Okay, let me just flip back to my to my presentation view. Okay, is that showing up? So actually, first of all, Malcolm, good question. My big on big tech is within my range, so I don't feel I'm underexposed or overexposed to it at this point in time. From a regulation point of view, I think there's a very, very high risk of um, some sort of government intervention in these companies. I think that risk is not going to be equal across the FANG stocks. I think that Twitter and Facebook specifically, I think social media is the most in the in the crosshairs. And that's why I don't hold those two. And I think to a secondary extent, you probably have Google and Amazon as the secondary risk factors. I think that will not happen before social media, and that's probably going to be on some sort of a monopolistic play by the Biden administration. I'm planning to keep this kind of level of exposure for the time being until I see what kind of moves the Biden administration makes against the companies that are not in our portfolio, specifically against Facebook and Twitter. Now, if those moves are aggressive, there definitely will be a knock-on effect. Like on that day, Apple and Microsoft and Amazon will drop 5%. But I'm okay holding these companies and taking that 5% hit because I think they're all phenomenal companies that will deliver great returns. And I think we will have enough warning before anything really extreme happens by monitoring the Facebook situation. Okay, I'll take the next question here from Jake. Hi, Jake. It's not off topic at all. What's my view on cryptocurrency at the moment? So I am bullish about Bitcoin in particular. I think that cryptos are a confidence play. There is no way to intrinsically value cryptocurrencies. So historically, they've always traded on, well, up until probably the last 12 months, they have always traded on either extreme pessimism or extreme optimism, uh, led primarily by actually speculation. Speculation was the main use case of cryptocurrencies up until about 12 months ago. So back in 2018, everyone was speculating they would go up, and we had a massive boom and new people getting into cryptos. And then that confidence was lost in 2019 when the bubble popped. What I'm seeing in 2020, in fact, is that there are new use cases for cryptocurrencies in areas like hedging against inflation, in areas like corporate treasury, and a new kind of confidence is building at a very rapid rate. So obviously Tesla took a very large position in Bitcoin in January of some $2 billion. Uh, Carnegie or Mellon Bank of New York recently started offering custodial services. I think that will continue. And I think that will remove some of the extreme volatility from crypto, though it is still a very volatile asset. Now, so Bitcoin really is the only um, the only counter that so the only crypto that has that kind of institutional support today. So I feel there's probably huge gains to be made in other cryptocurrencies, but they are going to be more similar to the 2018-19 kind of boom and bust cycle, where they're going to be driven primarily by speculation in their asset value rather than a real compelling multi-billion dollar use case like corporate treasuries. Hope that answers your question, Jake. So that doesn't mean they're good or bad investments. That just means they're a different kind of investment than Bitcoin at the moment. Okay, Malcolm, you spoke about China human rights trade war outcomes. You also spoke about the opportunity in India. Do you see similar risks due to increasingly divisive policies against Muslims, Sikhs, etc.? It's a very good question. So India is a very unique economy within Asia. Actually, the Indian consumers, I was at a presentation here in Singapore 2 years ago with a whole bunch of the top business leaders of the region, the academics. It was a very interesting seminar where they had different people talking about the Asian century from the perspective of of being here in Asia. There was one report from, I think it was the CEO of Nielsen, the big rating company in Asia, where he shared the results of a big consumer sentiment survey. The most bullish consumers in Asia are Indians. They have the greatest belief in a better tomorrow, in increased prosperity for their kids. And there is a massive correlation between populations believing that things will become better and them actually becoming better. It's a virtuous circle, right? So India, however, besides obvious problems like poor infrastructure, corruption, things of that nature, massive social conflicts between the Muslims and Hindus, for example, Hindu nationalism. From an economic point of view, the incumbent government of Prime Minister Modi does not feel it is standing on strong enough feet at the moment to feel confident, for example, to join the RCEP, the trade agreement I mentioned that China is kind of leading with the rest of Asia, which would have been a huge opportunity for India. He's worried that in the short term, Chinese imports will flood the Indian market, and he will basically, he'll lose power. So India needs to fix, from an economic point of view, its ability to take on foreign direct investments, to open its borders to international trade, to really capitalize on its full potential as a nation, from an economic point of view. But because of a number of things, including what Malcolm asked, the very divisive rise of Hindu nationalism and, for that matter, Muslim nationalism in parts of India, no one feels politically stable enough to make those short-term pain, long-term gain kind of choices. So it's almost going back to what I was saying about social cohesion being lacking in the United States to make those kind of choices on a strategic basis. Let me see. Question from Kevin. Do you feel there's a potential for health-related investments post-COVID? Interest in repairing the mental health, but also in trade investment, reversal of lockdown. So I think there is huge, massive health-related potential in post-COVID. So we developed a vaccine in 12 months that normally takes 12 years to develop multiple vaccines in multiple different countries around the world. The United States, UK, Germany, Russia, and China all have, from what we can tell, vaccines in record times with different medical strategies. I believe this kind of goes back to what I was saying about the hyper accelerated time to market for deep tech, and maybe deep tech is the wrong word, deep science, to commercialization. I think that will be true in medicine. In terms of investments, I have two problems with it. The first is I myself am not a big expert in pharmaceuticals. I have a surface level of understanding about the industry, and I have some very strong conviction also that small cap pharmaceuticals, your bio nanos and all these kind of companies, are in a bit of a speculative bubble at the moment. Yeah, so I would say that there's massive potential. I just personally don't have the skills to invest wisely on a 5-year basis in pharmaceuticals and medicine. How does a person for gain square? Okay, Malcolm asks, I'll probably take 2 or 3 more questions. I'll stick around the chat a little bit, but I'll probably kind of stop the main thing. So I'll take 2 more questions. One from Malcolm. In the event of a bubble burst, how do you expect your portfolio to do? Given the pressure that eToro puts month-to-month gains, do you worry that you will lose copiers? I'll start with the second one. That's very easy. I don't care. Honestly, there is a incentive for popular investors, a monetary one. It is something like 400 USD per month at the next. Also, I'll be promoted next month to the first paying tier. I can say with a lot of honesty that 400 or even $800 makes absolutely zero impact on my life whatsoever. So I don't have a monetary gain. By nature, people have very short copy windows, short attention spans in eToro. People come and go very quickly. That's the nature of the beast. What I do care about is the people who trust me, both the people, and there's some of you in the chat that I know, there's some of you that I don't have the pleasure of knowing in real life. But for people who are really putting their trust in me rather than making a 2-week or 1 month trying to make a quick buck, I take that very personally. I take that trust very seriously. And it is that almost fiduciary duty I feel towards your copies that will keep my head screwed on straight, rather than the chasing of copiers. And I don't care enough, honestly. This is not my source of income, and even if I progress to the top tier, it still won't be my biggest source of income. Now, what will I do if the portfolio crashes? Well, a few things. So there's kind of the leading into it, and then there's a when it happens part. So the leading into it, you already said, I'm going to try and ride the bull run. There are always some economic indicators which might or might not, depending on how violent the crash is, give you some indications that a bear market is coming. The ones that I'm personally looking at most closely are productivity, economic productivity, and inflation, especially with all the money printing going on. I think even an increase, let's say 2% inflation, would be a very strong signal to me to increase the size of the hedge. Now, I think the best way I can answer what did I do in March of last year in my other portfolios, or what did I do in 2008, 2009? It depends on the nature of what's happening. I will cut my losses on certain assets that I think are going to be the slowest to recover. Well, I will generally just keep the assets that I think, are just a matter of time, because I am investing on a 5-year basis, not a 6-month basis. If I have reason to believe, as I did in 2008, 2009, I sold all my banking stocks immediately. In fact, it was only like 2 years ago I actually bought into any kind of financial services company again. Because in 2008, 2009, I just fundamentally stopped believing in that industry. However, in 2008, 2009, I also kept most of my tech stocks, even though I took substantial 1-month losses on them. If you kind of look at the history of the S&P 500, over any 20-year period since the index was started, I believe in the 1930s, it's never lost money. Over any 10-year period, like any rolling 10-year period, it's in the profit 99% of the time, or 98%. On any 5-year period, it's something like, I'm roughly making up the numbers, but they're more or less correct, 85 or 90%. Any 1-year period, of course, it's like 55%, right? 60% whether the market's going to be up or down in that year. So I'm really not too concerned because I'm taking a long-term perspective. If my tech stocks are down 20% for 12 months, I'm sure I'll lose a lot of copiers, and so be it. But I don't think it makes sense to try and time the market and dump them on the way out. I would only dump things that I think are not going to recover in that 5-year time frame. So, and of course, I will take some hedging, some aggressive hedging positions depending on the severity of the crash. Okay, last question. For the world changing text of preference of big business space, government subsidies, big scale versus retailers. I'll take one more question about China, and then I'll end the stream here. Any insight into what a leadership shift post-President Xi in China, how that could affect things? So black swan type events on positioning since he kind of consolidated power. So I think from an internal politics point of view within China, there is relatively little to no risk that we will see. Well, I wouldn't say there's never no risk, but it's a very, very small risk that Xi will suddenly lose power if things go as they do now. Now, I actually wrote a post, if you go into my eToro feed quite recently, about what I see as the biggest risks in China overall. I think the biggest black swan event, which is maybe not even a black swan event, it's maybe a foreseeable event, would be a collapse of Chinese municipal debt, provincial debt. It's quite complex, but you can read my, let me check. I think it's one of my most recent posts on eToro. Yeah, just scroll down my feed. You'll see 2 or 3 posts ago, an overview about provincial debt. I think that is the number one risk, and that could potentially set off a chain of events so severe that it might topple the Chinese economy for 5 years or something, and perhaps President Xi with it. But besides that, it would take, I don't know, like something pretty crazy to happen, I guess. Okay, guys, first of all, thank you very much for joining. I hope you found it useful and interesting. And I really want to say again, thank you for your trust. I take the copies that you've made in my portfolio very seriously, and I hope I'll do a good job. Okay, take care, guys, and Happy New Year for everyone in Asia. Bye-bye.